US and even with the China market as well. So in that sense, I think Malaysia market is actually in resilience in that sense. But if you've seen how US indices has been performing over the last at least for the past couple of months, they are hitting all-time highs. But Malaysia scene is totally different. So I think the divergence is yet to stay. But I if you based on historically speaking, whether the behavior of a strong US market will probably translate to a strong Malaysian market. I think that relationship may no longer hold. So the dynamics between the US and Malaysia is clearly different. And I think as long as the gap is getting wider, there's persistency in that gap. Now, I think the second major factor is, or rather, the first major factor with regards to Malaysia scene is always you talk about foreign inflows and outflows. I think foreign inflows are very critical. They are the one that drives, inflow to the country and indirectly also driving inflows to the economy. So, you want a strong major index, you need to see inflows coming in, especially with the foreign players. Second thing I think is domestic economy. As long as you have a strong economy, I think it's basic economics. Strong economy translate into stronger or higher index performance. We've seen that in US. To a certain extent, you look at China. China economy is not doing well, so therefore it's actually pressuring on the index as well. So index performance are very heavily reliant on the domestic economy. So there's no exception for Malaysia as well. It's very driven on how the domestic economy is going to perform. External market, as just mentioned. Now, besides US, besides China, obviously there's also regional markets like Southeast Asia, and I think importantly also, that will brings you to other factors like oil prices. Oil prices, Malaysia being Malaysia is a very commodity-driven economy, so you have high oil prices. Normally, that will boils well to the general economic performance. So high oil prices normally will benefit Malaysia in general. So these are all external markets factors. Now, political climate, whether it's domestic or international, both will have an impact. Obviously, domestic will have a larger impact. Now, political climate is something that's unpredictable. If you are trading index for quite some time, this is a risk that you find it very hard to hedge. Now obviously futures, you have ability to short sell. You can short the market if you think or review the market in time to come is going to come down. That gives you the flexibility of using a futures market. So I think political climate is very is an important factor that you very can't predict. Last but not least, I think ringgit strength plays an important role. Now, ringgit strength also heavily dependent on how the US dollar is going to perform. Is as long as US dollar is strengthening, you have a weaker ringgit, and generally in a weaker ringgit environment, it's not going to benefit the market in general. We're going to see that later on a couple of charts to show you the relationship and illustrate between the factors and then how it affects the index performance. So just going a bit on this year's outlook, I think January IMF is actually quite optimistic. Surprise is actually quite optimistic. I think January, if barring Trump, not doing too crazy things, you should see a strong economy in especially in the developed countries, and this is in regards to the U.S. economy. Now, if Trump were to intensify the trade war and the tariff war between each of the respective countries, that's a different question. So watch out. I think IMF do publish their quarterly reports, and I think those quarterly economic reports are important to watch. If you are watching the space, that will probably give you a trajectory on how the world overall global economy is going to perform. But I think in the latest report, it shows that now they're actually quite optimistic, bearing that any unforeseen policy uncertainty coming from Trump. Now, Trump being Trump, the first administration was actually pretty good. So US in general, being the leader of the global economy in certain sense, is actually doing well. And I think it will continue to perform well. Now, again, this is all subject to volatility. Now, obviously, if you just look at the news flow that's coming in, inflation is something that's watching very closely, especially the US market. Now, with tariffs kicking in and in a reciprocal way, which means that if US impose tariff on certain countries, a lot of these countries is going to reciprocate as a result. So therefore, I think the general price of goods is not going to stay low. So inflation is a major hot topic for this year, and that will create a lot of chain of other economic factors as well. Now, if you just look at the first time, I think tariff when US and China went into the first tariff trade war, you can clearly see I think US did record a higher GDP in probably in the first couple of 6 to 8 months or so, but thereafter, when in the midst of that trade war, in the middle of that tension, we start to see that actually US GDP starts to deteriorate. Whether this time is going to be different, Trump 2.0, that still begs the question. But I think there's a lot of uncertainty ahead. Now, I think Trump, my personal opinion is that he could mellow down, given that for the fact that he's understand how the dynamics play out between the first trade war with China back in his first administration. So I think this time around, I think it's probably going to be mellowed down. There'll be more negotiation on the table. But having said that, these are all uncertainty, and therefore I think markets is going to be very volatile. Now, the reason I put up US is because US is whatever, whenever US sneezes, the rest of other markets catches. So no different in Malaysia. I think when US starts to show weaknesses, I think that will reverberate across major markets. Now in US market itself, I think US market is generally still quite resilient. Sentiment is still strong. Obviously, I think the Trump feel good factor is just still kicking in. So the first 100 days administration is very important to as a report card to see how Trump is actually performing in terms of his second term. Now, in terms of valuations, equity valuations in US is actually very stretched. If you look at the most of the tech counters in US, valuations are way overboard. But again, they are justifiable by strong earnings, and the earnings are still showing robust earnings across the board. So that's something that is keeping the market to where it is today. Now, the key thing is that China, on the other hand, it seems China a bit laggard, in the sense that economy is actually performing badly. So therefore, it's reflected in the index. But however, I think that in recent weeks, after the DeepSeek renaissance, a lot of these US tech counters start to realize that China dominance in the AI field is also gaining popularity. So therefore, I think that will minimize the gap between the US techs and the China tech companies. Eventually, I think China will play a catch up. But again, I think China is being dragged by a massive economy, downturn in regards to their property prices. Now, inflation is something that if you are watching the market this year, is a common theme that is going to play out. Inflation is going to get very stubborn. Reason being is because with tariffs, things is not going to be cheap. In fact, I think if US impose tariff on across major of important goods and from major importing countries, that generally will create general inflation across the board. And with persistent inflation, that generally means interest rate is not going to come down. And when interest rate is not going to come down, your dollar is going to be strong. When dollar is strong, other emerging currencies, especially the ringgit, is going to stay weak. And that will affect the KLCI index in certain ways. Now, the reason I want to point to inflation is also because if you just look at not only on crude oil, although has actually came down quite substantially from 100 US dollar to 70 US dollar, and this is what Trump wants. It is really down to other commodities. I think vegetable oil to a certain extent. You look at your coffee and cocoa prices; they are actually some of these commodities are actually all-time high. So these are creating a lot of inflationary environment and a lot of cost pressure. So inflation is something that is going to be very persistent and it's going to be very stubborn. Now, when it comes to rate cut, there's always a saying, don't fight the Fed. Now, I think there's a new saying, don't fight Trump, because Trump is putting out his remarks is as though he's trying to dictate what the Fed should be doing, or should do with regards to the rates. Now, if you just look at where the dot plot is, look at rates is going to be staying quite elevated for quite some time, especially in the US market. Reason being because inflation is still quite stubborn. And you just look at latest inflation print that's just announced, it looks like US inflation is probably going to inch higher or creeping higher, and that's not a good sign. So as long as inflation is stubborn and is elevated, rates is going to remain high as well, and that will mean a stronger dollar. Now, if you just clearly see, US majority of the three major US indices, the Nasdaq, the S&P, and the Dow Jones, they are way outperforming the FKLI. Now, in those days, whether it's before pandemic or even the first 2 years after pandemic, you can see a close relationship between FKLI and a majority of the US indices, in the sense that they move quite parallel. You have a strong performance on Dow Jones or S&P, that will reflect a strong performance on FKLI. But now we can start to see divergence are appearing. Now, really, I think US market is very driven on its own fundamental, mainly driven by the tech companies. Now, even though valuations are stretched, I think investors are still banging on the AI team, and at least for quite some time. So as long as earnings are catching up with valuations, I think those index can stay elevated for where it is. The question is FKLI. I think FKLI in certain ways has actually been quite laggard, and is driven by a lot of factors, and mainly because the foreign flows that's coming into Malaysia has actually dwindled quite substantially. Given the fact that interest rates in US is highly attractive, the gap between the US and Malaysia interest rates actually narrowed quite substantially. So a lot of funds are moving out of this region and going back to the respective domicile back into the US where they actually enjoy higher interest rate. So foreign inflows and outflows are very critical when it comes to FKLI performance. Now you can clearly see this. So if you trade based on Dow Jones performance and you want to relate that to KLCI, you can't do it anymore. Those days both these indices are moving quite parallel. Nowadays you can clearly see there's a divergence between Dow Jones and the KLCI market. So when you have strong performance in Dow Jones doesn't not necessarily means it's going to translate into better KLCI performance. I think we need to take note of that. So if you are trading based on relationship between these two markets, you have to be careful. Now, if you just look at how Trump has impact, the first term from 2016 to 2020, you can see that generally the market for Malaysia as a whole during the first administration was actually quite neutral in the sense that the market is over the 4 years period is actually heading to nowhere. Obviously, discount towards the end of a Trump administration where we are actually entering to the height of the COVID-19 pandemic. If you discount that, I think generally the market was actually quite neutral. Obviously, there's slight ups and slight bumps and a bit of dips, but generally the market was actually on sideways. So will this time be different? Will Trump 2.0 usher in a different scenario for the market? It still remain to be seen, but I think definitely for the US market, it's definitely in an up cycle. But in terms of technical per se, US market, when you have a trend that is so strong and you don't see a correction in the middle, I think that trend is find it very difficult to push to greater heights. So in any healthy trend, you should see a bit of retracement in cycle, but we yet to see that, and it's yet to happen. So I think US market is clearly on a brink of probably a correction as is about to come. Now, looking at China, so besides US, I think China also plays a very important role for the KLCI index in the sense that first when you look at the US relationship and the KLCI, you can see that there's a divergence. But when you look at when you compare China index, the SSE index, or even the Hang Seng index, you start to see there's a bit of parallel in terms of the both movements. So in a sense that I think in terms of the exports reliance and Malaysia as a whole is actually more closely related to China economy rather than the US economy. So again, I think you can draw parallels. Once China economy starts to deteriorate, you can really see that Malaysia index performance also got hit as a result. So the China factor is actually a stronger link for the KLCI performance as compared to the US factor. So you can see this red line here, which is your Hang Seng index, is actually moving quite in line with where the KLCI is moving in general. Now, obviously, there's period where it's actually diverging, but I think in totality, you can see that there's a bit of parallel movement between both the indices. Now, talking about China, China is very a wild card. If you just look at IMF projection, the way they are optimistic is purely looking at US, and they are discounting the deterioration in China. Now, China can be a wild card simply because they are fighting on a lot of economic fronts. First thing, they are fighting a deflation. While the rest of other countries are fighting inflation, China is fighting a deflation story, whereby prices of goods are actually declining on quarter to quarter or yearly basis. That shows a sign of a weaker economy. Now, whether that will last, it really depends on China's government policy. Will China government step in and increase stimulus measure? It could, but we have seen that we start to see last year's October or September pump priming, policy announcements start to fade. And when impact like this starts to fade, really the government needs to put in much more effort to really revigorate the economy. What steps to be taken? Much to be seen, but I think China is really a wild card for 2025. Now, surprisingly, I think why the US and China trade war is actually getting more intense is because China trade surplus actually hit a record high at almost 1 trillion US dollars. Whether this is because, in anticipation of Trump coming in, a lot of countries actually, push their exports into the US or out of China just before any tariff action is going to be implemented. So, let's watch in the next couple of months whether this trade surplus will start to shrink. If that happens, this will be another major front for China. So China, in terms of economic headwinds, there are plenty, and it will take a knock-on effect for quite some time for China to really, reinvigorate its own economy. And if that happens, I think that will also be a boon for our local index as well. Now, really, I think China, in terms of growth, despite they are hitting their target last year, this year may be slightly different. Deflation is always a common problem, and it's a major problem. If they don't address deflation aggressively, I think that's going to be something that they really have to watch out closely. So deflation is a theme, which is a very opposite story of what US is facing. US is facing a creeping inflation, or China is facing a totally different scenario. Is facing a deflationary pressure. Now, again, I think China, whether this is due to trade war, the reason is the economy is also not doing well. Is a lot of foreign flows are going out of China. Now, this is in anticipation of, again, the U.S. and China trade war that's probably going to be aggravated by Trump's policy. So, last few months or last few weeks, you notice that there's a lot of outflows coming out from China. That's why the index is being pressured. Now, if you just look at why, our KLCI performance are also being dragged, it's also because mainly the China index are also not doing well. So, with this drag, with this trade war that's getting more intense, this is going to aggravate the foreign outflows out from China. So that's something that we really have to take note as well. Now, coming back to our Malaysia front, again, I just like to highlight, the index performance are very much driven by, foreign inflows. If foreign inflows are not coming in, it's just very difficult for the index to actually climb higher. So, foreign holdings, especially for Malaysian market, is actually quite on a low point. Given the fact that, again, US markets, because the US interest rates are quite attractive at this point in time, and they will stay elevated as long as inflation is remains stubborn in US. That will really create an outflow, especially in this region. So Malaysia is no exception. So as long as foreign shareholdings are low and foreign outflows are still there, it's very difficult for index to climb. Now, if you just look at cumulatively, I think foreign outflows actually been coming out of the market since before the pandemic. Now it got aggravated, during the pandemic, and it got worse, especially when US starts on the interest rate hike cycle. Now it very much depends. Hopefully, when things starts to fade, and really inflation starts to come down to a comfortable level, I think Federal Reserve will probably put a brakes on interest rate hike and start to look at interest rate, cuts, and that will probably bring back some of the inflows back into the country. Now, looking at ringgit, obviously, if you just look at past relationship, a weaker ringgit doesn't voice or doesn't gels with a strong index. Normally, a weaker ringgit gels with a weaker index. That again also represents inflow. So, when there's more outflows, there's more pressure to the ringgit. That will also bring down the index performance as well. So right now, I think generally, if given that the interest rate hikes in US is not going to be imminent. In fact, I think this year, some markets are saying probably there's one rate cut and that's it, or maybe there isn't any rate cut for the whole year. So that means the rates in US is going to stay elevated. So that again will pressure a lot of emerging country currencies, especially with the ringgit as well. So that will also weigh in on the index performance. Now, oil, given I just mentioned earlier, Malaysia economy is very well driven in terms of oil prices. So high oil prices is good for the country. Low oil prices is definitely no good. So Trump being Trump, he did mention that he prefers a low oil price, and since then he made that remark. We have seen how oil prices actually reacted. So oil price actually been holding around at $70 US. is definitely, anything that's below 70 is again going to push, the it's going to weigh down on the index KLCI index performance as well. Generally, because I think our index is or rather our economy is heavily related to crude oil performance. So right now, I think the crude oil outlook seems to be, Trump is putting his finger on it. He's trying to control oil prices through, actions from OPEC and whatnot. But again, I think the dynamics can change. You never know. But overall, a low oil price environment is never good for the index performance. Now, when it comes to index seasonality, if you break down over the past decade, if you break down by month to month, you can clearly see, the seasonality impact for FKLI is not so imminent. Like those days, you can see that the December and the January effect, usually these 2 months are usually a strong performance month for index as a whole. But now it's pretty mixed across the board. But generally, you can see that, August, September, or pretty much September, October period are usually the weak periods in the index, and also followed by May. The saying goes, sell in May and go away. Does hold to a certain extent, but at certain years it doesn't reflect that. So, seasonality may help you guide you in terms of identifying periods where KLCI performance is strong on a certain period. But again, these are all historical per se, and things can change as a matter of fact. So, serve it as a guide, but don't use it as a tool for you to trade or make trading decisions based on it. Now, I just want to share a little bit on looking at the KLCI index futures with regards to the KLCI index. So comparing the futures and the index itself, which is the underlying. Now, like I mentioned earlier in the beginning of the session, there is a difference between that. There bound to be a difference between the index futures prices as well as the index. Reason means because there's a dislocation in terms of price. Keep in mind, futures market is tradable. Is an exchange market, so people can obviously come into the market and sell and buy depending on their views of the market. So sometimes, you can see there's clearly outperformance in the futures, whereby the futures prices are trading higher than the index. Now, this is very common in markets where you're expecting the market to rally, or there's optimism in the market. Now, vice versa, if you start to see the futures index are trading below the index, this is what we call a discount market. This is usually happens when, people are actually, sentiment wise, is actually quite bearish with the overall market. And usually when people are bearish in the market, what they do is that they go to the futures market and then short a position, and that will actually lower down the futures prices as compared to the index. So this gives you a hint, or rather a sentiment gauge on how the market overall behaves. And is the market looking at more bullish scenario going forward, or is it more bearish scenario? Now, over the past couple of days, we have clearly see that, futures performance, to a certain extent, they have actually been a premium market. That means the index performance actually been generally, or rather the index itself has generally been very weak. But then again, the premium starts to erode and become a discount market. And that's where, once it becomes, futures becomes a discount market, that means, the index is actually poised for further downside. And true enough, I think these are the things that the behavior between the index futures and the index itself could possibly paint you some sentiment play along those lines. Now, again, just to highlight, since that futures market, we have, quarterly contracts and month-to-month contracts for you to trade. And now, if you plot those prices together, you can see that, clearly the market is the near month markets are trading much higher prices compared to the further months. So again, it's indicating to you there's a bearish mode in the market, or rather there's more risk on. People are taking more short positions in further months because of uncertainty that's presumed to be in the market going forward. So this type of sentiment is also weighing down on general sentiment of the market. So from there we can gauge, as long as, where we're seeing the market for the foreseeable future is still quite bearish, in the sense that people are expecting there's uncertainty, and therefore they're actually going to the futures market to hedge or to sell a contract to hedge their position. So these are all, sentiments play that you can gauge the overall market sentiment through all these prices that's available on the future month prices. Now, on the last bit, talking about trends, trading tools that you can use. Now, I think the key thing is that in a trend market, in a trendy market, whether it's on a bearish or bullish phase, is always important. As long as the market still trends, find an opportunity to be with the trend rather than against the trend. So if the market is showing you that it's a bullish phase, find positions for you to long rather than short. Always trying to pinpoint a reversal in the trend is not easy, because the trend can go for extended period. You have seen that in Dow Jones, you have seen that in S&P 500. Many people are thinking that, oh, probably this is the peak, all-time high is going to be, today is going to be all-time high, and that's it. Tomorrow you start to see reversal. If you do that, most times you'll definitely be losing money. So when the trend is on a bullish phase, find positions for you to long rather than short. Now, obviously, trends can also be identified using shorter-term periods using especially Heikin-Ashi candles. Now, Heikin-Ashi candles, I'm not going to go too much on the detail, but it's actually a derivation of a Japanese candlesticks. So, if you just look at Japanese candlesticks, it's you have open, high, low, and close. Heikin-Ashi using a fixed formula to represent the candles. So, in a sense that it's taking the average bar of your Japanese candlesticks. So, in a sense, it reflects trends in a clearer manner, which we're going to show you on a later chart. And in the sense that if you are trying to identify shorter term trends, Heikin-Ashi candles can reflect to you those trends much better. Now, besides that, you can obviously use moving average crossovers or DMI crossovers as a strategy to pair with Heikin-Ashi for you to time your entry and also potentially your exit strategy. I also just going to introduce to you ADX, which is a trend indicator as part of a DMI indicator. ADX is important because there's no, once you identify the trend, bullish or up or bearish, it's also important for you to understand that how strong is the trend. Is the trend, if you entering a trend where the trend starts to get weaker, where the ADX value starts to decline. So if you start to see ADX value start to decline, especially during an uptrend, then you shouldn't be thinking of longing position. Maybe this uptrend is probably facing exhaustion. So ADX value or the line itself will give you an indication as to how strong the trend is behaving. Is the uptrend still persisting or the downtrend still persisting? Last but not least, as I mentioned in the beginning, markets are getting volatile. So make sure you have a way to get yourself stop out. And one way is to manage your risk is to use an ATR value, which stands for average true range, which measures the range of your daily bar or your period bar accordingly. So with that, you can use a multiple of ATR value to calculate your exit position or even your target profit. So let's go on. So you can see that this is your FKLI performance. Now, clearly, if you just look at a long-term trend, we have broken down below the 50 and 200 period EMA, which is not a good sign. It's telling you that the index is actually poised to go down further. As long as it doesn't break, the 1620 or 1630 is telling you that the market is still quite bearish in the short-term perspective. Now, if you just look at this chart, chart A and chart B, these are equal period, same product. The only difference is the type of candles that's being used. Now, chart A is what we call your normal Japanese candlestick, which is available on majority of the platform. Chart B is your Heikin-Ashi candle. So you can clearly see if you compare chart A and chart B, chart B shows you the trend in a more clearer manner. So in the sense that if it's a downtrend, it's represented by the red candle bar. If it's an uptrend, it's represented by the green candle bar. So you are in the trend longer, unlike Japanese candlesticks where every candles, if it change in color, is telling you that potentially the trend may reverse. But if you use Heikin-Ashi, which is taking the average of the bar, is actually keeping you longer in the trend. As long as the color of the trend indicating to you that the trend is still persisting, then you should be in the trend. Now, another major reason why Heikin-Ashi is widely used for trend trading is because the color is based on colors. Red means it's downtrend, green means it's uptrend, and there's only three distinct patterns that you need to know. First thing is that as long as you have a green body bar, the bodies are white, and with the upper wick is telling you that this uptrend is there or is the start of an uptrend. And vice versa, if you start to see a red body bar with a down wick candle only, and the bodies are white, it's telling you that this bearish trend is starting or is a downtrend market. And if you start to see like doji type, your body is very small, but the wicks are very long, and the series of red and green candles together side by side, it's telling you that this market, if you start to see this, especially during an uptrend period, it's telling you that this uptrend is probably going to be exhausting. There's no more strength in it, and you have to be careful. So if you have long position prior to this formation, you should be out of the market, because generally when you start to see dodgy type of candles, small body candles, and red and green candles side by side, it's telling you that market is heading sideways. There's no direction. So it's important for you to distinguish. So if you're holding position prior to a market that is going to face exhaustion, you should be out of the market. Okay, so just to show you the dynamics of it, this is green candles is telling you that generally the market is still trending up. This is red candles telling you that generally the market is downtrend. And you can start to see that if you start to see series of green and red and almost like a dodgy type of candles, it's telling you that this market is heading to no direction. Now in a market there's no direction, you can't use trend trading strategy, because if you use trend trading strategy in a sideways market, you get a lot of whipsaws. There's always a lot of signals, and therefore you're losing a lot of opportunity cost or transaction costs. Now, comparing the difference, Heiken-Ashi is again widely used because it's easy to use, easy to identify, and it's quantitative. That means there's a fixed formula to calculate Heiken-Ashi. So if you are using algo trading or automated trading, you can definitely program Heiken-Ashi as part of your indicator tool. And therefore, I think Heiken-Ashi is more to trend flowing, while Japan's candlesticks is more of reversal patterns. Now, besides Heiken-Ashi, if you pair that with moving averages, it gives you quite a good, fairly good signals, in the sense that moving averages, you can definitely look at crossovers, whereby you pair two different periods of moving average. One's a shorter term and one's a longer term. So crossovers are simple in the sense that whenever the shorter term crosses above and the green candles appear, it's telling you that this market is poised on to go on the upside. Now, vice versa, if you start to see that the shorter term moving averages line crosses below the longer term, and red Heiken-Ashi candle starts appearing, it's telling you that this market is what we call bearish crossovers, and this market is poised to go lower. So crossovers are simple in the sense that you pair two different period moving averages and to see the crossovers accordingly. So you have to pair that with the Heiken-Ashi bars as well. Now, I think moving averages is not only acting as a crossovers strategy. You just look at it, it's also a dynamic support and resistance level. So as long as the candles staying above both the candles, is telling you this uptrend is still quite persisting. Occasionally, there's obviously candles that try to test below. So you have to wait for a confirmation in the next subsequent candles whether the candles are still persisting to break below both the lines. If it does, it's telling you that this uptrend is going to be changing trends, and it's going to turn into a downtrend. So, moving averages also act as a support and resistance point for most of your candles as well. Now, if we just, I just want to introduce to you this DMI tool. And again, if you just look at this red and green line, so red is basically your minus directional index, and your green is positive directional index. Now, notice this: whenever the red crosses above the green, it's telling you that this direction is going to be bearish. Now, it's also very similar signals with our moving average crossovers. So this is a bearish crossover. Reason means because you start to see red Heiken-Ashi bars and the shorter term crosses below. So DMI gives you a very similar signals and moving average. So in the sense that you can choose either one to pair whenever you look at Heiken-Ashi signals. So because since they are giving overlapping signals, you can choose either one whenever to as part of your indicators tool to identify entries and exit strategies. But what is important is I want to highlight is the ADX, the black line here, which is part of the DMI tool. Now, this black line is what we call ADX, which again, I mentioned earlier, measures the strength of the trend. So what we have here is that this is a bearish crossover indicated by a moving average. This also again is a bearish crossover indicated by DMI, which is the negative DI crosses above the positive DI. But what I want to highlight is that this black line here, this black line actually rises. When this black line rises, that means ADX value is rising, or ADX is rising. Now, once ADX is rising, it's telling you that this downtrend that we are seeing at the start is possibly going to have higher momentum. As long as this ADX is rising, it's telling you momentum is strong. Right until where ADX starts to decline, that means that this downtrend is probably going to be peak. So if you're holding a short position, this probably will be a good time for you to be out of the market, judging from ADX value itself. So looking at it, once the ADX starts to show you a sign of exhaustion peaking, it's telling you the trend is probably going to be tired. It's probably going to be facing sideways market, or probably this downtrend or uptrend is going to be exhausted. Same goes for here. This is what we call a positive crossover, whereby the positive DI crosses above the negative. Again, there's a bullish crossover on the moving averages with green Heiken-Ashi bars, strong Heiken-Ashi bars. It's telling you that this uptrend is probably going to stay some time. Reason is because this ADX is also rising in line with the signal. So ADX is an important gauge, no, or rather important tool to gauge the strength of the trend according to the dynamic of the market. Last but not least, always important to have a way to get yourself stop out, just in case the market go against you. I think one of the ways is to use ATR, which I mentioned earlier in the slides. So ATR at this period is actually 5 points. So when you start to see signals for you to enter, this is a very good entry signal because the red energy bars are starting to appear, and the bearish crossovers are starting. And the key thing is that ADX starting to rise. Once ADX starts to rise, it's telling you that this downtrend is going to gain momentum. So ATR value of 5, a way for you to calculate your stop loss is, to short. Let's say you find an entry to short at 16.16, your ATR value is at 5 points. You work on a risk to reward ratio of 1 to 2. So you're looking at 10 points of profit, 5 points of stop loss, and you should place your entry and your target levels according based on your ATR value. Now, keep in mind, ATR values will start to get higher once the market become more volatile. So once ATR value rises, that means your risk and reward is also going to rise accordingly. So make sure that do up to your comfortable level in terms of your risk management, but always make sure you have a plan to manage your risk. So this is what happened next. The key thing is that despite the market, once we get our target profit level executed, the market still continue on in our favor. The key question is because ADX is still rising, it's showing you no sign of stopping. Now that's a plan is a plan. If you have planned for you to get a strategy to get you out at a certain point or target level, just follow according to your plan. There's always opportunity for the next setup, the next trade setup, and whatnot. So always important, be disciplined in the sense that to approach your trading plan accordingly. If it's a plan to get you out, a plan to hit your profit target level, and then so be it. Keep that as your trading plan per se. Despite the market still showing you there's plenty of opportunity or more room opportunity to be in the market. So again, there's always you can execute the next trade plan accordingly, but importantly, be disciplined enough to adhere to a plan that you have for yourself. So in terms of outlook wise, FKLI still remains under pressure given the fact that short term wise candles are still below both the 50 and 200 period EMAs, and the highs are getting lower. You start to see lower highs, and once you start to see lower highs, it's telling you the market is generally on a downtrend. Now this is what is surprising is that ADX is declining, showing you probably the market is going to range at this point in time. But this negative DI is starting to rise. It's telling you that this downward momentum is probably going to gain some strength in the periods to come. So watch out. I think the 1600, the FKI level seems a bit quite stubborn to break and hold above. So that's going to be a really resistance in the near term. But then again, I think the market is also well supported above the 1550. So watch out. I think this is a range that you can play with. And on the intraday perspective, that's obviously looking at Heiken-Ashi. Whether it's 30 minutes or an hour time frame gives you a bit of opportunity as well. So conclusion, I think if you just look at where technical per se, the outlook remains still quite bearish in the near term. ATR value is actually declining. That means the market volatility for the time period showing you that probably the market is going sideways. But then again, Trump era is not going to be a neutral volatility. It's going to be greater volatility. So be prepared. I think as long as news flows coming out from US, whether it's regards to tariff or not, it's going to create a lot of volatility in the market. So with that, ATR value is going to rise, which means that your risk and reward ratio is also going to be quite substantial. So keep in mind, higher market volatility, you have to make sure that you prepare for greater buffer for your capital against any potential loss in the market. Now, US tariff will definitely have an impact, especially on Malaysia market. Given the fact it's still too early to be known whether US is going to do tit for tat or not. But judging from what we're seeing in the news wire over the couple of days, it seems that really I think US is definitely going to impose quite serious tariff on any trade imbalances. And I think Malaysia is definitely one on the list. So it means to be seen what kind of action is going to be taken. But having said that, I think foreign fund flow is still weak. and think this is what keeping the optimism in the local index at bay. So this is basically the FKLI contract specs. I'm not going to go too much on it. You want to find out more, just speak to any of Philip Capital guys. They're more than happy to guide you further on how to trade the index and the specification of the contract itself. So just highlight a few points to reiterate why you should be looking at the futures index is because no, if you trade stocks, you understand that the FTSE Malaysia index, the KLCI index comprises of 30 components. For you to gain a exposure in the index market as a whole, is very difficult because technically you need to buy an exposure of every single 30 counters in the index. It's not easy. So one of the easiest way you can do is always look at the futures market. Futures market gives you an easier opportunity, and in the sense that it gives you more freedom. Freedom in the sense you're able to sell the market or short sell the market if you are having a view that the index is underperforming, probably potentially in the future. So futures is cost effective, flexible, and if you're having a portfolio of stocks, it's important to consider the futures index as a way to hedge against a portfolio of stocks. You never know with this kind of volatility that's coming in the market. It's good to have something to hedge against your stocks portfolio, and I think futures is a great way to hedge it. Now, trading hours are also slightly different compared to your stock markets. They generally futures market have a longer trading hours. So even we have a night session market on the Malaysia index futures, that gives you an opportunity for you to react to any news that's coming in, especially from the US, which usually comes in at night on our time. So with longer trading hours, it gives you also a bit more flexibility in that sense. So with this, I'm going to end here. I'm just going to hand it over to Charlie for any questions from the audience.
All right, thank you so much, Mr. David. So now we'll move on to the Q&A sessions. There's this question: Malaysia export to China is getting lesser compared to export to US. Will it affect the core relationship of KLCI to China or Hong Kong?
Yeah, it is likely to be affected. But I think it's still too early to really assess the impact or damage lah. But I think as long as see, Malaysia is in a pickle. We have we start to see heavy exports to the US, and US don't like it. We also start to see lesser export reliance on China. Now, I think despite this, the co-relationship between the Malaysia and China market is still pretty much there. But I think it's importantly also to reflect on what's going to happen in the US, because that ultimately also going to have a major impact for Malaysia as well. So I think to answer the question, despite us seeing lesser exports to China, I think the co-relationship will still remains, because it's pretty much this region against the US, and that's the play that they're looking at.
All right, thank you. So the next question will be, does FKLI have trading potential every day, and how many points to target daily?
Okay, to be fair, I mean, it's everyday opportunity in FKLI. If it's a new, I mean, if the range is very tight, you don't see much opportunity. To be frank, unless you start to see on a probably want to do a swing trading, which you talk about few days, then probably there's opportunity. Now, when markets are volatile, especially when US starts to be more volatile, or even in China market, that also will translate more volatility for Malaysia as well. So I think in that sense, you really can see that there's opportunity if the markets are volatile. But other than that, if you talk about intraday per se, it's difficult because generally the Malaysian market is, like I say, is quite resilient. So therefore lesser volatility as compared to other markets. But if you look at more on the medium frame or time frame, talk about swing, then there's more opportunity.
All right, thank you, Mr. David. The time is running up, so I think we'll end the Q&A sessions.
Yeah,
So,
thank you very much.
all right, thank you. All right, so before we wrap up, if you're interested in opening an account with us, feel free to scan the QR code here or reach out to us after the event. And if you'd like to dive deeper into futures or stocks trading, you can also request for a private coaching session to get personalized guidance. And we'd love for you to stay connected with us. You can follow us on Facebook, Telegram, LinkedIn, Instagram, and TikTok for the latest market updates, promotion campaigns, and event announcements. You can also subscribe to our YouTube channel for educational videos and visit our website for more information. And we do have two Telegram channels, one for stocks and another one for futures and CFDs. Feel free to scan the QR code to join these channels to get some information. Alright, here's the contact information for all of our branches. You can reach out to us via phone, email, or just simply walk into the branch. And with that, we've come to the end of our webinar. Thank you everyone for being here tonight. We truly appreciate your time and we hope you found this session valuable. A big thank you to Mr. David for his excellent presentation. We hope you enjoyed the webinar and we look forward to seeing you at our upcoming events. Thank you and have a wonderful night ahead.